Happy Thursday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Thursday, June 6th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio, you need to be a client of 42 Macro. So today's key macro events are tech dominance, commodities lagging, and cracks in the U.S. labor market. In terms of market implications, consensus expectations for a soft landing to be reported across growth, inflation, and labor market data have spurred rotational flows into defensive factors like growth and quality, rapidly inflating tech stock market caps in the process. We believe this trade can continue in relative performance terms, given that inflation is more likely to surprise to the downside than growth over the medium term. The US is, however, at an awkward stage in its growth expectation cycle, which limits upside in absolute terms, especially over a medium to long term time horizon, given positioning cycle headwinds. Cracks in the labor market currently represent mere cooling from above trend conditions rather than the start of more draconian from the perspective of the business cycle and asset markets. Transitioning to our 42 macro dashboard here. As always, a wrap up with a question from our community. This one reads, right tail risk scenario. It says, hi again, Skipper. Thank you for answering my previous questions with the detail that you do. Thinking out loud, from what we know today, liquidity cycle dynamics will almost certainly negatively inflect in Q3 2024, with coupons taking up a higher proportion of fiscal issuance. However, given that we will be edging closer to U.S. elections, there is surely a non-zero probability that Janet Yellen may opt to draw down heavily on the TGA account instead of replenishing it to $850 billion. This could be the case, especially given that the fiscus remains funded only until September. I'm not sure I follow that part. Your thoughts around this potentially supporting risk assets, and how do you incorporate this into your liquidity assumptions at all? So great questions. Let me unpack that in order here. So the first thing I'll say before I even answer the question, let me just take a step back and provide an important coaching point. One thing this question does is it speaks with certainty about the future, which is, in our opinion, a no-no from the perspective of managing financial market risk. That specific statement is, from what we know today, liquidity dynamics will almost certainly inflect negatively in Q3 2024. We don't know anything with certainty about the future. What we think we know is, based on the evolution of current data and where we believe we are in cycles, we can predict, we can attempt to predict the future with some reasonable degree of accuracy and consistency. But the reality is the future is still inherently unknowable. So we should apply more humility when we think about managing financial market risk through the lens of these critical cycles. Go back to the question, is there a non-zero probability Janet Yellen may opt to draw down the TGA? Yes, that is a non-zero probability, but the highest probability is that that she does what she's intending to do, which in our opinion is tighten financial conditions in order to perpetuate positive inflation outcomes for President Biden on the campaign trail. That continues to be one of the areas. Inflation and the economy broadly continue to be areas where Joe Biden lags former President Donald Trump in the polls. And so, in our opinion, the hawkish Q2 quarterly refunding announcement, which we talked about 6 weeks ago, in our opinion, very much represented a step in the hawkish direction from the perspective of the Treasury's impact and influence on financial conditions. Getting into our thoughts around this potentially supporting risk assets. So yeah, if Janet Yellen opts to no longer want softer inflation and wants to goose the economy and asset markets heading into the election, then yes, that would obviously support risk assets. But again, our job is not to invest according to possibilities. It's invest according to probabilities. And we obviously anchor on our risk management systems to do that best. But if we were going to choose between possibilities or probabilities in terms of our fundamental research, we're obviously going to go with the probable case. And the probable case is that based on the guidance we received from the most recent quarterly refunding announcement, the TGA is going to be a headwind for asset markets, particularly from this low level relative to both the end of Q2 and end of Q3 targets. And then just broadly with respect to liquidity, we've done we've done a tremendous amount of empirical research on the liquidity cycle for our clients here at 42 Macro. And one thing I will say on liquidity broadly is that when you the things that tend to be most inversely correlated, the factors that tend to drive liquidity the most tend to be inversely correlated to liquidity. Things like the U.S. dollar, currency volatility, bond market volatility, and interest rates, real interest rates. Those things are all moving in a direction that is supportive for the near-term liquidity outlook. from a global liquidity perspective. Now, that doesn't necessarily mean U.S. liquidity is improving, but we would argue that it is improving to some degree, just given what we know about the movement we've seen and things like the TJA and RRP in recent months. Is that sustainable? We don't believe it is based on the TGA dynamic. But the most important takeaway here is that these all things need to be netted out. We talked about for the past couple of months is this kind of awkward divorce that we've seen from U.S. monetary policy and U.S. Treasury net financing policy vis-a-vis our Jay wants a soft landing and Janet wants a softer inflation theme. And that awkwardness and that that awkward dichotomy, that divergence, is not something that we report to be able to understand how that is going to influence asset markets on a net basis over the medium term. But one thing we have a decent amount of confidence is that if we're right on our expectation for accelerated shelter disinflation to show up in the data over the next couple of quarters, then it may be the case that Jay Powell's influence on U.S. and global liquidity may overwhelm Janet Yellen's influence vis-a-vis declining U.S. dollar, declining U.S. interest rates, dragging down bond market volatility in the process, dragging down currency market volatility in the process, and all those things from a Fed signaling perspective can contribute to an uptrend in global liquidity vis-a-vis private sector liquidity, which is inversely correlated to all those things. So again, this is a very complicated situation, very complicated time to be an investor. We're doing a tremendous amount of empirical cycle analysis to help our clients understand these dynamics. But the reality is, I don't know the answer from an ex-ante perspective. But what we do know is that our risk management systems have kept us on the right side of market risk, on the long side of market risk across most factors, most cyclically oriented factors since the beginning of November. We're very proud of that. This is a hard time to be a investor that's reliant on predictions to guide the changes that they need to make in their portfolio in order to stay on the right side of market risk. We're actually quite proud of the fact that we have had very little turnover from the perspective of what our discretionary risk management overlay and or our systematic portfolio construction process has been signaling for the past 7-8 months. And the reason for that is because we're, the risk management systems are the most powerful tool that we have built and rely upon in terms of keeping our clients on the right side of market risk. So discussions like liquidity, positioning, growth, inflation, that stuff all matters in terms of helping us anticipate the evolution of those risk management systems. But if you want to make and save money on a consistent basis in asset markets, our choice and our path that has been benefiting our thousands of clients across the world, the path that we've chosen is to anchor on those risk management systems, and they continue to work. They continue to get our clients paid, irrespective of the words that are coming out of my mouth on this program or in any other podcast, because at the end of the day, the risk management systems are where the real juice is from a portfolio standpoint. So we're wrapping up there. Darius Dale presenting our macro minute for Thursday, June 6, 2024. Everyone have a wonderful day. Best of luck out there. We'll catch you back here tomorrow. Cheers.